It's September 23rd, 1998, a total normal Wednesday, unless you were on the 10th floor of a Manhattan skyscraper, where a room full of men in $5,000 suits were sweating harder than a cat at a dog show. Who were they? Only the heads of every major Wall Street bank, plus the New York Federal Reserve. So yeah, just a typical afternoon finance apocalypse. What had all these people panicking? A hedge fund. Not a war, not a global depression, just one fund. Long-term capital management. And it wasn't run by amateurs, it was a dream team. 2 Nobel Prize winners, a formal Fed vice chair, and enough PhDs to fill a TED Talk. For 3 straight years, they printed God-tier returns. Wall Street worshipped them, and then they blew up. So hard that the banks stayed once outsmarted, had to bail them out together, hand in hand like a financial group hug. Even the Fed stepped in like a tired parent saying, "Fine, I'll clean up your mess again." LTCM was pure hubris, a laboratory of geniuses convinced they were too smart to fail. They were the first true quants, no vibes, no headlines, just math, leverage, and a blind confidence. When John Meriwether, Johnny, left Solomon Brothers, he built his Avengers, the brainiest crew ever assembled to trade bonds. They raised $1 billion plus before even proving anything. Investors bought in on pure IQ flex. And the numbers? Insane. 1994 plus 28%, 1995 plus 59, 1996 plus 57, 1997 plus 25. After fees. Unreal. Their weapon of choice was a convergence trade. Find 2 nearly identical bonds, buy the cheaper one, short the expensive one. Wait for prices to meet in the middle. It's like 2 Starbucks across the street, one selling lattes for $4, the other ones for $4.50. You buy cheap, short pricey, and profit when they sink. Each trade made maybe 1%, so how do you make billions from 1%? Leverage. 30 to 50 times leverage, because if you're right, it's rocket fuel. If you're wrong, it's TNT. And everyone let them borrow it because the models say they were safe, because the geniuses said, "Trust us." Then reality hit back. The Asian financial crisis, 1997, currencies collapsing, markets melting, LTCM supposedly independent trades all started tanking together. 9 uncorrelated bets, all losing money in perfect harmony. Did they panic? No. They doubled down and even returned capital to investors. Big flex. Huge mistake. Then Russia defaulted in 98. Investors fled to safe US treasuries, which LTCM happened to be shorting. Volatility exploded. Their models said 1 in a billion. Reality said, "Hold my vodka." In days, they lost nearly $2 billion. Still salvageable if the market calmed down. Meriwether calls for help. Buffett, Soros, Goldman. Buffett passes, Soros passes, Goldman listens, then dumps similar trades, cold-blooded. Johnny writes investors begging for support. The letter leaks. Bloomberg front page. Every bank suddenly wants its money back. Margin calls hit like a rapid fire. To raise cash, they sell positions. And every sale drives prices lower, which makes their losses worse. A feedback loop of doom. It's like trying to put out a fire by throwing gasoline. LTCM's equity drops to $400 million. Exposure, $1 trillion. The Fed looks at this time bomb and says, if this thing blows, the entire market goes with it. They lock 14 banks in a room and say, fix it. The result, a $3.6 billion rescue package. Not charity, self-preservation. Because if one domino fell, they all would. To cool the panic, the Fed cut rates by a quarter point. That's a move reserved for once-in-a-generation disasters. 9/11, Lehman Brothers, COVID, and LTCM. One hedge fund earned its spot on that list. Over the next year, LTCM quietly faded away. Meriwether tried again. The Nobel guys went back to academia, and Wall Street learned, or claimed to learn, a lesson. What nearly killed LTCM? Leverage. Sure, ego, absolutely, but the real killer? Blind faith in models. They believed math could tame markets, but markets are made of people, and people panic. LTCM flew too close to the sun with a calculator. Bonus round, lessons, that slap. Lesson 1. Leverage cuts both ways. 30 to 50 times leverage means a 2% loss wipes you out. According to the BIS hedge fund that levers over 20 times are 40+% more likely to face forced liquidation in a crisis. Lesson 2. Models don't predict panic. Humans cause it. During 2008, correlations between supposedly independent assets spiked above 90%. When fear hits, diversification dies. Lesson 3. Ego kills more portfolios than bad trades. LTCM literally returned investors' money in '97 because they thought they were too good for more capital. A year later, all gone. 60% of fund managers' mistakes come from overconfidence, not lack of skill. Massive IQ, bigger blind spots. Let their loss be your cheat code. Trade smart, stay humble, and remember, true quant investing isn't about building the smartest model. It's about managing risk like your life depends on it. That's what we teach inside Quant X, turning data into discipline and discipline into an edge. Join the Quant X community, study stories like LTCM, not to repeat them, but to master the math and the mindset behind resilient trading. Because data doesn't lie, ego does.